This is 5% of US GDP. This is huge, and there's more in the pipeline. Be globally diversified is a key message. I mean, I mentioned the new clean technology indices up more than 150% year to date. Consider all these new disruptive technologies. It will change our life, but it will also change the landscape. Definitely get familiar that the Asian area, and with in the lead China, but also the area itself will, over the next 10 years and probably over the next 50 years, dominate global growth and become the center of the world. Ray Dalio will publish in spring a book where he basically shows the rise and fall of 5 superpowers, and his prediction is that the next superpower will be China, and in relative term, the US will lose some ground. Nevertheless, he doesn't foresee that the US will completely lose the influence globally. It will be probably a duopolistic situation. I find emerging market in general, and in particular short-term Indian equities, interesting, because the soft macro data are basically telling you the opposite of the key macro data, and the equity market has rallied over the last 2 months, roughly 13%. Bonds, we are investing experts for high yield for corporates. We continue to see some value, much less than 9 months ago, but still around 4% in US high yields, a bit more in Asian high yields. We wouldn't go too low, so single Bs only in cases where you really did your homework and in limited doses, but it still delivers you a certain return. If you need diversification and protection, I would first buy gold, physical gold, and only then add some government bonds, which deliver you either negative real yield, negative nominal yield, or negative real yield, like in the case of the US. But they are a certain diversification and a certain protection, but you will definitely not buy them for return. I've said it before, I must repeat it. I see no cheap asset around the globe. I mean, selectively, some small caps, global small caps, are, compared to their own history, compared to large cap, cheap. But then it gets really tricky. Obviously, value stocks are cheap, but a lot of value stocks, like, for instance, European banks, they are definitely cheap for a reason, and they might continue to stay cheap for a reason. The balance sheet recession problem should be tackled, and with the latest fiscal package, it looks like it's going really to be attacked, and that should create some growth. My personal belief is still that this rally will end in euphoria, in a melt-up, and this melt-up gets more and more fuel through fiscal and monetary stimulus. If we were really to see the roaring 20s, future will tell us, but definitely all these stimulus will create a kind of inflation, which is in asset prices. The hope is that with the fiscal packages, we might finally see some investments. The US package has the intonation to help the unemployed, the poor, which is definitely a good thing, and they will use the money for their daily life. What I haven't seen so far is tremendous packages to invest into infrastructure, into clean energy. This would definitely create growth, and this would probably put us out of the liquidity trap, if I may use the Keynes expression. And with that, I really come to the end, and I thought this time I give you a quote which is much older and probably wiser than the one I had the previous times. So markets can remain irrational much longer than you can remain solvent. And with that, I would say I have made my key questions, and I would like to open it up for questions. Thanks a lot for listening.
Thank you very much. Thank you, Andreas, for this very detailed summary. We've got a few questions here. Maybe we shall have a few more, but we don't have too much time for them. Probably the first question is that our viewers were impressed with this slide, with this chart of outgoing freight from China. And really the question is, well, first, where exactly these figures come from? Were they estimation or were they real statistics? And the second, where did they get those ships? Did they build them? Or did they freight them from Japan or US?
There are two questions. First of all, the chart was taken from Goldman Sachs. I actually have another source, but it's a Goldman Sachs chart. Second, there are a specialized institute which collect for markets like China real-time data. Google is one for instance, for traffic. I don't know in particular who collected that one. But this index, this freight index, is quite known, and it is based on real transactions. There are other indicators, like, for instance, how much lorries travel or how much trains with cargo travel in China, and they all tell you a similar picture. There is a significant pickup. And I was amazed too. That's one of the reasons why I believe that China will surprise on the growth side next year. These figures, nevertheless, you cannot fake them because they are really based on real transaction and what is on ships. But I didn't pull them together myself, so in the end, I must trust that the person who did the homework did it well. That's the disclaimer, unfortunately.
Okay. Yes. Well, it looks quite an aggressive growth. This other question from Simeon? Why you are saying that the cash is risky? Do you expect deposits expropriation like in Cyprus, or banks crash, or something like this?
Well, first I have stolen that statement from Ray Dalio. He thinks in dollar terms, but the question is, if you have cash in a bank, you can spread it in various banks and profit from these insurances you have, for instance, in the Eurozone. So in nominal term, I would say cash is not at risk, but that's the wrong comparison. If I have €1 today, what is this euro worth in 1 year from now? Well, first of all, I pay to store it. The accounts are not for free any longer. Negative yields or punishment yields you pay. Then you have very low, but you still have inflation. So you have a second number which reduces the value of your cash. And Dalio on top of it says the dollar, given that it gets weaker, is on top of you, giving you less power to buy goods abroad, to go abroad on holiday. Short term, if I think in ruble terms, that is obviously the opposite. The ruble got stronger, so if you were to travel, at the moment your cash is worth much more. But down the road, all this money printing must create inflation in various ways. You see, for instance, the oil price. If the oil is at $30 or at $60, in the end, if you don't change your consumption, your way you, for instance, use it to heat, it will cost you down the road more cash than today. And this is more meant to tell you in real terms, if you hold cash, you are going to lose over time. That's nothing new. But today, the situation different to the past. The holding of cash is even punished.
Mm-hmm. Okay. What about the region? Well, our region we are presently the emerging markets, particularly Russia and Eastern Europe. You mentioned that India probably is a good outlook, but what do you think about Russia? Is driven primarily with the oil increase, or there are some longer term reasons for that and longer potential for good times?
I mean, first of all, we invest in Russian dollar bonds, in hard currency corporates. They had a tremendous year. As you better know than I do, most of these companies are either at the edge or are already investment grade. You made a tremendous capital gain. The yield to maturity is unfortunately getting lower and lower. So Russia did definitely certain homeworks well. It's not just oil. It's also the technology, the development. Russian equities measured by Shiller P, they are ridiculously cheap. Obviously, Americans, they hesitate to invest into Russian equities. I would definitely, when I allocate to emerging market equities, allocate at least a slight overweight to Russian equities compared to a benchmark. And if I'm not benchmark oriented, I would definitely allocate some money to Russia, not just because of oil, although I think oil might continue to go up further. You have also banks, you have also technology, although obviously certain mining areas and energy is dominant. And for the Western world, we probably need to learn that although you are still classified as an emerging market, if I look from the bond angle, most of your bonds, of your corporates and also the government bonds, you are rather at the lower end of investment grade.
Mm-hmm. Thank you. Artyom is asking about the US. What levels of US inflation do you expect when the economy recovers and money flow accelerates?
That's a very tricky question. If I quote Mr. Powell and the Fed, they have recently published their PCA, that's the deflator of the GDP, for the next 4 years. For all the 4 years, the PCE inflation, which is not CPI, but it has some correlation, they don't expect that figure to overpass 1.7%, knowing that they have told us the goal is that we will see on average a 2% inflation, but the forecast of the Fed is below their target, and it's and they said over on average, and even in a punctual forecast for the next 4 years, they don't see that. So therefore, my assessment is that the CPI figure for at least the next 12 months should not overpass 2%, because in the end, the Fed keeps rates low. Real life is really tough in America, so there are still more than 15 million of people who are unemployed. The recent initial jobless claim figure were much higher. It is really hard to see inflation, and on top of it, this disruptive development of the technology and the economy is dampening inflation fears. So therefore, not knowing an answer, but I stick to the Fed, and I don't think the Fed errors on the high end. I would even say, unless we really see next year this 3 to 4 trillion stimulus, which Nancy Pelosi announced, they will probably not reach their 2% over the next 4 years. And with that, you have lower for longer, you have more financial repressions, or be it nominal or at least real yields, which are negative. This is all meant to be, actually. It's the only way you bring over the time period debt to GDP down. But next year, debt to GDP globally, in particular in the US, is going to grow significantly. 5% of GDP, almost 5% of GDP was announced yesterday. And if the two parties were able or will be able in January, February to agree, you might see another 5 to 10%. And if you do that math, this has a tremendous impact on growth, at least short term. But I would not yet expect to have an impact on CPI. The balance sheet theme, if you believe in that, which I do, obviously, otherwise I wouldn't tell you that, it takes a while until the private sector, so corporate and private individuals, start to invest and not to repair their balance sheet / saving. The first fiscal package, the American household got $1,200 in cash, and for each kid $600. This time the figure is half. But what did they do? Most of them didn't spend it. They paid down their debt of credit card. I think I even have a slide. We had that last time, but maybe I can show you if I find it. Here. Let me share it with you. Here, you see, the white line is the credit card balances, and the blue line is what kind of limit they would be available. And you see this year, due to these fiscal packages, instead of spending, although the consumption went up, they actually paid down debt. And with that, it is hard to see inflation down the road, and also growth. And the question is, how much time will it take until you see the corporates and or the private individual to spend? What we have seen is that corporates start with the cheap money to restart share buybacks and to pay dividends. But this doesn't really create growth, and it's not really investments. But it gives you, as an investor, an additional source of return.
Okay, thank you. And the one question concerning the crisis, the financial crisis cycle. Do you think that the financial crisis cycle has the tendency to shorten to 3-5 years, within 3-5 years?
What do you mean by that shortened, or which financial crisis? Because, since 2008, or to be precise, since March 2009, every time there was a little hiccup in the market and or in the real life, central banks and nowadays governments just come out and give you money. And with that, the cycles so far, they are really hard to see. I mean, we haven't seen a recession since 2009, assuming that this year only Q1 was negative growth, because Q2 was definitely positive. Q4, Q3, okay, probably another negative quarter, but if you take the definition of a recession, there was no recession, and the financial crisis we only had in 2008. They hardly ever happened in history. We had the Great Recession, but even that, it's 2008 and 2009. So unfortunately, for those who hope of, let's call it a recession, a crisis, that it cleans up the market, at the moment, we do not see that. As long as governments and central banks keep giving us more money, more cash, more stimulus, more drug, if you will, it will end up in a melt-up and probably in a tremendous crash. But I think we are still not there. I cannot tell you if it's 2 years or if it's 5 years from now, or if it happens next year, can also happen. But at the moment, the elephant in the room is the COVID, and the medicine. You see that for almost daily there is more stimulus in one way or the other. Also, the money spent for the vaccine, at least in my country, you get for free the vaccine. There is a certain hierarchy: first the old people, etc. But bottom line, this is for free. This creates also growth, but no inflation. So I at the moment, I don't see any crisis, but I see too much complacency, and a correction can happen really anytime soon. But what happens in a correction? I mean, yesterday, Europe down 3%, America flat, Asia down 1%, Europe more than 3%. Today, a snapback in Europe, great, 1%. Yeah, but the rest of the world didn't even have this hiccup. So even if there were a certain correction, Europe will be hit the most and the first.
Mm-hmm. Okay, thank you. Still, let's hope that next year we can expect to be reassured, and probably if COVID issue will become less acute, then the year will not be as difficult as this one. So thank you again very much